Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today. On October 17th, 1983, a small bank started up in Santa Clara, California. It was a relatively small player on the global and national banking scene, but over time, and particularly in the wake of the financial crisis in 2008, its assets, deposits, and overall financial footprint increased dramatically, to the point that in 2022, it had total assets measuring approximately $211 billion. It reliably made profit, held a positive assets liability ratio, and to all external observers, it was something of a wunderkind in the banking system until March 2023, when it all came crashing down. And over the course of a weekend, in truly spectacular fashion, Silicon Valley Bank, or SVB, imploded into nothingness. Federal regulators were forced to step in very rapidly. There was a fire sale on distressed assets. And while there's some measure of official existence, Silicon Valley as an independent entity no longer exists. And it was one of the greatest volume, greatest value bank crashes in United States history. Now, there are some questions that emerge in the wake of this. The big one is, what happened to cause the crash? There's been much that's been written about this, and we'll definitely talk about this, but in many ways, this is rather algorithmic. We can look at very specific things in terms of value X shifted to something else, and therefore financial product Y had a change in value, and all of this accumulated to create the collapse of Silicon Valley Bank. But really, the deeper and more significant question that we need to get at is, why was Silicon Valley Bank in a position that these changes created this crash? What decisions did they make? What choices and what sort of risk appetites were present that led to them taking these positions that meant when these certain rather mundane financial changes occurred, they had no recourse and essentially disintegrated? That's what we want to go over today. And Rich, you and I have talked about this for years now, maybe not years, but a year now. And I remember back while the crash was unfolding, this became a real-time workshop in the class that I was teaching, because this was such a spectacular failure of risk management and even just risk recognition. So, opening thoughts?
Thank you, John. Yes, you were able to take this into real time in your class. I wound up taking it real time into a different class where we focus largely on the regulatory failure, because even though this is indeed a risk management failure of management itself at the bank, it is also a shared fault with the federal regulators for the bank, and indeed a failure of banking regulation as a whole. We'll touch a little bit on that during this podcast as well.
Sounds good. Yeah, I've put most of my attention on this towards the cognitive biases and the heuristics and the thinking within the Silicon Valley Bank leadership and board of directors. I've not given as much consideration to the regulatory side. It's just not a space that I have quite the same familiarity with. So this should be an interesting conversation in terms of trying to parse out what was the aggregation of factors that led to this collapse. I know that on a behavioral side, there are some things that were really interesting to me. The risk appetite of Silicon Valley Bank was a very interesting thing, in my opinion. If we look at some of the numbers in terms of what their holdings in terms of uninsured assets were, they seem to have a very high risk appetite. And this is, I would argue, backed up by a lot of other behaviors that we've seen them take. Like, for example, they did not have a chief risk officer for almost the entirety of 2022. And that particular office was only intermittently held. There were periods where they had CROs, and then there were periods that they didn't. It didn't seem to be a priority for them. And even in the wake of Dodd-Frank, where there was such a huge premium put on official risk management within an organization, it never really seemed to be a major priority for them. There's an additional part that I think is very easy to look at and just laugh sardonically or laugh defeatedly, one might say. But When this collapse was unfolding, their chief administrative officer was formerly the CFO of Lehman Brothers. So you have a whole lot of individuals who seem to have very skewed or asymmetric risk appetites. And I would argue, I don't think we've talked about it on this podcast yet. Risk appetite itself is made up of two different aspects. There's the risk preference, that sort of subjective aspect of how much risk do you like? How much risk are you comfortable with? And the risk perception, which is how do you understand the probabilities and likelihoods of a particular outcome? I would argue that from what we see, it seems as though they had a very skewed risk perception. Their understanding or appreciation of the probabilities of events seemed very incongruent with what those actual probabilities were. You have any thoughts in this?
I absolutely agree that most of the problem in terms of the excessive risk appetite that appeared to be in place was contributed by a general low probability perception of the events that played out. And I would submit that one of the key biases that they were impacted by was availability bias. The fact that interest rates had been at rather low levels for multiple decades, that rates had started to come down in the late 80s and early 90s, continued to fall to levels around 2% or less. And the idea, the notion that interest rates could go back up so severely, so quickly over an 18-month time span, just to quote numbers, there were 11 rate hikes by the Federal Reserve between March 2022 and July 2023, comprising a total 550 basis points of rate increase, something that clearly the folks at Silicon Valley Bank, and I would also argue probably at most bank managements, did not see coming. It did not foresee and probably had that as a significant black swan or severe tail risk type event.
And I think this all plays into something that I observe in doing my research around this, which is there's been conversation about moral hazard and moral licensing in terms of some of the behaviors displayed by the management here, but I don't think that's exactly correct. I think this is a case of what I would characterize as feed forward optimism. We've talked about how optimism is an essential characteristic of any sort of participation in markets and investment. You don't do these sort of things unless you are optimistic, unless you believe your chances are better than average of outperforming whatever the underlying rates are. If you didn't believe that, then you would just invest everything in treasury bonds and sit back and make 5%. So nobody invests without optimism. The fact that we are alive today and have been for however many years of our lives we have tells us that what we're doing works. Now, extrapolate this to Silicon Valley Bank. They had years upon years of great returns, of really positive asset growth. And this led them to take what, in retrospect, were very high risk positions against interest rates and assume that interest rates would continue to stay as low as they were, despite the fact that there is historical precedent that these will change. Their own optimism basically told them everything is going to be okay. They had a confirmation of what they already believed about their own positive outcomes. And then when these positive outcomes continued, they just kept doubling down. They just kept moving forward with it. And we see this pop up in some other choices that were made. I don't want to go into them quite yet because this is a web of dysfunction, let's say, in terms of what happened at SVB. But the fact that they did have, just looking back from 2018 through 2022, their total assets grew from $56 billion to $211 billion. And year over year, both their assets and their asset liability ratio increased. So this, I would purport that this basically led them to believe that we're okay, that what we're doing is fine. And when you see 5 years in a row of growth with no fall, with no major exposures, this leads to a huge amount of overconfidence.
I'll go a little bit further on that, John. So you brought up two very useful and relevant statistics in terms of not only the assets, but the ratio of assets to liabilities. I would go beyond that. The common equity tier one capital ratio which is a key metric with regulators, has stayed relatively strong, greatly exceeding the minimum required by regulators. And in fact, had been that way for the previous 5 years at the end of 2022. So just keep in mind, that was less than 3 months before the bank had that massive crisis that led to their ultimate demise and takeover. So it's in some ways understandable that management there felt particularly comfortable with where they were, maybe even more than comfortable, despite the fact that there were storm clouds on the horizon.
And I think that's a really important point because it's very easy to look at all of this, to look at the year over year growth, to look at the optimism and the capital ratios and the asset liability ratios and say that, okay, this is all understandable. Anybody would have done the same with these particular metrics in front of them. But there's something that has not been given a whole lot of conversation that I found very interesting in terms of what was observed and what was done that maybe works against, in some ways, what both of us have been saying, which is that there were failed stress tests. In 2022, there were stress tests done internally, not as required by Dodd-Frank. In fact, it's worth pointing out that because of particular regulatory nuance, SVB was actually exempted from most of the stress tests required by Dodd-Frank. But they did conduct internal stress tests. And early in 2022, there was a stress test that they failed quite spectacularly. And this internal stress test showed that even with small increases in federal interest rates, they would find themselves in quite a problematic position. And one would think that the normal response to this would be to, okay, let's perhaps correct our position. Let's change up some of our asset balance, some of our holdings, so that we can find ourselves in a more defensible position should such an exposure occur. But that's not what happened at all. In fact, the management response was to change the model inputs and change the model assumptions until they received a positive result on their stress test. We talk in the course that we teach very often about cherry picking results and projecting confirmation bias on models, but this almost feels malicious.
It certainly does. And again, having been through in my career the challenges of performing these types of what if tests and these types of stress scenarios that you're looking at, it can be quite challenging when results do not show what management either expects and or hopes for. It's very important for the modelers to make sure that whatever they are bringing to the table in terms of results, that they can support and justify the assumptions. Having said that, these tests can be very nuanced, particularly if they are internally driven. And therefore, management may feel compelled to make sure that they've really thought through any significant results, because it is our nature that when we see a particularly tragic consequence coming down the line, to pause and say, is that really going to happen?
So then you don't think that there is any intentional burying of results or duplicities. This would be more just well-intentioned attempts to correct what they saw as a flaw or error in modeling.
I'm not going to put myself necessarily in the shoes of management. I don't know what they were thinking. Nobody does.
Sure.
That was outside those walls. What I am suggesting is that with regards to some of these tests, there is a range of assumptions that can be deemed reasonable. And therefore, there is a scenario of interaction between the modelers and management that is not necessarily malintended.
I can get behind that. And I think when you look at the self-interest that sort of piles on top of that, the fact that they had been earning money quite substantially for many years past, and I have to assume that as executives, they were probably being quite well compensated for these returns. There was an interest in not seeing negative results, in not seeing major risks that required contractions or corrections of positions that would reduce that revenue flow. This is a natural consequence of loss aversion. We don't like to lose things that are positive. And when it's been going on year over year, we tend to think that it's already landed, that this year's profits have already occurred. And that makes us even more reluctant to part with them. So I can absolutely see then how, while perhaps incorrect or inappropriate, it wouldn't necessarily require a duplicitous or malicious intent to correct or modify the results or assumptions of a model.
So I think we have to try to put ourselves where at least plausibly things were. And let's look at the facts as they were at the beginning of 2022. The Fed was in the middle of, as I mentioned earlier, 11 rate increases. I don't know exactly what number they were on, but they weren't done. They had already implemented a number of them. And the question was, how much further were they going to go? And if you're management, you're thinking, wow, the Fed has already implemented, let's say, 5 or 6 rate increases. I don't have that number off the top of my head. That is, I don't want to say unprecedented, but they haven't done anything like that in decades. And I do mean decades. We'd have to go back to the Volcker era in the early 1980s to find a similar number of rate increases. So if you're management, you're thinking they must be done. And inflation had already started to temper itself somewhat at that point. So getting back to a narrative that you could get behind to support your current business strategy, it's quite plausible to say, yeah, I don't think they're going to go that much further at this point because they've already taken quite a bit of drastic action. I can easily see a management telling themselves that's the most likely course of action. So let's just ride this out because the Fed doesn't want to make things that much worse for not only the banking industry, but for the entire investment community.
And this plays to something additional factor that I don't think really requires any sort of specific error or bias, or certainly not any sort of ill intent or mistake on the part of management, which is something you and I, again, have talked about amongst ourselves for years now, which is the variable baseline problem.
Mm-hmm.
Silicon Valley Bank had put their investment positions, and in particular, their federal bond holdings, they had made those choices based on certain sets of assumptions, based on a model that they had put together, that they had tracked. That's what they stress tested. They had their model that said, here is how we allocate our assets. Here is the returns we can expect to see. Here's what our assets and our liabilities are going to be. And as I'm looking at the numbers here between 2018 and 2022, clearly that model worked really well. They clearly had figured out what was going on quite effectively for their own purposes.
Well, it's interesting because it depends on what you define as success or stable or okay, how you define those terms. I would submit that one of the biases that came into play here is the law of the instrument and the emphasis in particular on focusing on the capital ratios, which I quoted earlier, as well as earnings and returns on equity. So those are the 3 metrics they largely focus on, along with growth in deposits, growth in total assets. And by the way, I'm not saying any of those are unimportant, but in the context of a bank, they're not sufficient.
So then I'm going to put you on the spot here a little bit, or quite a bit, as it were. And what metrics or KPIs would be more core or essential or necessary to really ensure the proper risk management and health of a bank?
Well, it's not enough for a bank to be solvent because all that solvency means is that you have sufficient assets to meet all of your liabilities. Banks have more than that. And in fact, really any organization does. You can be perfectly solvent as an institution. And if you cannot convert your assets to cash on a timely basis to meet these obligations, you're in just as much trouble.
And I think that definitely tracks with some of the numbers we see in terms of their percentage of uninsured deposits that they had over time, because this whole time that their assets were growing and their asset liability ratio was growing, their percentage of uninsured assets was growing simultaneously. And I don't claim to be anything resembling an expert in the banking space, but in the span of 5 years, they moved from 80% uninsured deposits to almost 94% of uninsured deposits. So that, to my naive and ignorant ears, that sounds really high.
Absolutely. That's an outlier in the industry. Most banks have a much higher percentage of insured deposits than they do uninsured. The proportion, I won't say is necessarily 90-10 insured, but it's going to be closer to that for a lot of other banks. In the case of Silicon Valley Bank, the fact that they had so much uninsured deposits lines up perfectly well with their business model and explains their growth in that they largely took in deposits from Silicon Valley, folks in Northern California, a lot of entrepreneurial types, a lot of tech startups, and even more established tech firms where they had balances well in excess of 250,000, which is the limit on any insured account.
And I think all of this supports that initial hypothesis we put forward of the pernicious optimism that was endemic throughout the organization. If you're operating at 80% or 90% uninsured assets, both as a depositor and as an institution, you have to be completely certain that nothing bad's going to happen. We're going to be fine. Because otherwise, that is a ridiculous business model.
Well, and there's one other assumption that goes into that overconfidence and optimism, which is that their customers, the owners of these tech firms, are going to continue to grow, to generate profits, to be able to attract more and more capital to deposit with Silicon Valley Bank. And that clearly did not happen. The tech industry took a big hit. There were quite a number of firms that were struggling. In addition to the Fed's increasing of interest rates, the other triggering factor was that a number of their customers started to struggle and pull cash out. And the initial wave of withdrawals is what triggered Silicon Valley Bank to take a $1.8 billion loss on their bond portfolio. They actually had to recognize it. It went from being an unrealized gain, which they just had to show as part of their balance sheet, but went under the line, right? So unrealized is not, it's not realized. So it does not flow through to net income. It doesn't flow through until you actually realize it. And even then, John, I want to make the point here. Banks will often carve out any realized losses as one time. So they will not be part of normalized operating earnings.
I think that at some point in the future, we definitely need to have an episode where we talk about unrealized gains and losses and how that plays with the problem of intertemporal discounting. Because I have to wonder, to what extent were these unrealized assets inappropriately considered simply because they were not above the line?
So I will address that in this way. There are two forms of arbitrage that bank management routinely does. And not just, by the way, not just banks. I don't want to pick on just that sector. I'll also tell you it goes on in the insurance industry all the time, and that there are many smart people at these companies that their job is to find ways to leverage the rules, to find the loopholes. In fact, I'll confess that was part of my job at one time, to find where these inefficiencies were so that more risk could be taken.
I used to contract for the federal government, and I have also played that game quite extensively in my career. Yeah, finding the loopholes seems to be a very lucrative line of work.
So let's talk a little bit about two places where Silicon Valley Bank's strategy exploited loopholes in the capital and accounting structure. Let's first talk about the capital side. As you pointed out, they were taking this big, huge wave of deposits from tech entrepreneurs, and they were investing them not just in any long duration bond, but in government bonds. So what they were doing was playing the yield game between the long end of the treasury yield curve and the short end. And because the capital rules focus largely on credit risk, the capital required for them to hold on these investments was actually quite low because of the focus on credit, not on the duration mismatch.
Interesting. Okay.
So the second form has to do with accounting and financial reporting arbitrage.
Okay.
And the general recognition in the financial reporting world that anything that is not recurring does not fall under the normal operating earnings that are reported. Not that it won't flow through net income, but that in providing a press release, in having an earnings call with investors, those one-time gains and losses will be carved out And there's good reason for it. It's certainly not malicious or an intent to deceive. In fact, if anything, the reason that they're carved out is because of the term one time. So the fact that they are considered one time allows management to carve them out and present a more predictable stream of earnings, one that investors can work with and project, because things such as realized losses or gains are not things that are easily predictable.
That ease of predictability, particularly when we're talking about financial markets and financial behavior, is, I think, one of the major boogeymen of any and all financial endeavors. We all know axiomatically, of course, that you can't predict the market, you can't time the market, but nevertheless, people seem to either A, think that they can, or B, think that there's far less volatility or unpredictability than there genuinely is.
That's true. And that's why the stress tests are so important. And that's why, in particular, there was a regulatory aspect to this. There was part of this issue, in my humble opinion, is regulatory driven. And there were biases. We've been talking about the cognitive biases of management, and clearly they were there. Everything we have said so far is very much on point. There were clearly issues around overconfidence and optimism. But I would submit there were also a number of issues with regards to what regulators were thinking. And it's not all the fault of the regulators. Part of it is what I would call the defanging of the Dodd-Frank stress tests. The biggest one being that minimum asset size for a bank to have to perform stress testing was increased from $50 billion to $250 billion as part of the 2018 Tax Relief Act that took place during the first Trump administration.
That's quite the change. That's a five-fold change from the previous threshold to what it was changed to. And even at its peak, it seems as though SVB fell underneath that.
One other thing to keep in mind that I don't think has been talked about very much in the press is that as part of implementing the changes in Dodd-Frank, banks were split up into 4 different categories, largely based on size. And what happened to Silicon Valley Bank as their asset base grew almost 4 times between 2018 and 2023 is that they moved through all those levels. And what's important about this, John, is that each of those categories has their own set of regulations, and even in some cases, who the primary regulator is, which adds another level of complexity for any bank that's rapidly growing. There can easily be, and I would submit there was a dropping of the ball.
Yeah, as a practical matter, then you'd have a complete lack of continuity of oversight. And tying this back to one of the original points you made about something else entirely, a huge loss of availability on the part of whoever the regulator at the time happened to be. A complete lack of familiarity of what had SVB been doing and what was their trajectory.
And I would submit it goes beyond that into mental accounting, as in, this bank is in my jurisdiction. Oh, I didn't know that bank was in my jurisdiction. How did they get into my jurisdiction? On top of it, I would also submit that these additional changes, while I think well-intended, also have added complexity to the overall regulatory structure of banking, which, by the way, is not new. I think one of the reasons the banking sector has been plagued over its entire history is because of the complexity of regulation, which of course creates additional cognitive load and a certain amount of paralysis and a sense of uncertainty, where regulators are going to act on status quo and in some cases do the minimal amount.
So it sounds as though a lot of the remediation that we might be looking at for the future is on the regulatory side and not entirely on the banker side or organizational side. That there are equal measures of corrective action that could be implemented on SVB side and on the regulator side.
Absolutely. And in fact, the Federal Reserve's own report card on the SVB failure signals to that. To my knowledge, there has been no significant change in regulation. I don't know if anything is going to come out, especially with the change in administration, with Republicans holding power throughout Washington. this is not going to come to the top of the list, not only because of the political situation. I'm not sure Democrats would have done much about it either, but also because there were only a handful of banking failures. It did not become a contagion, unlike what we saw back in 2008.
It didn't, but from what I've seen, it was a bit of luck that it did not become contagion. Or if not luck, it was a near thing.
It could have occurred, but I think the regulators did what they have to do. And this, I think, leads to some of the commentary that you alluded to earlier about moral hazard. If we look back to what the Fed did, they allowed for liquidity. One of the key things was they allowed banks for a period of time to be able to be compensated for assets that were underwater because of the large shift in interest rates. They were able to use those assets to collateralize liquidity at full book value, not the underlying lower market value. The idea of that was to create additional comfort. On top of that, they, for a period of time, allowed for insurance to cover all accounts, not just those up to 250,000, which was even true for Silicon Valley Bank, Signature Bank, and First Republic. There are a couple of points that I took out of the Federal Reserve's report card on what happened with the SVB failure that I think are telling and really speak to many of the lessons that you and I have been sharing with our students and clients. The first is, I think, a very important statement. They said, and quote, "We need to develop a culture that empowers supervisors to act in the face of uncertainty."
That's a fascinating statement for a number of reasons. I'm curious where the follow-up is because I could offer a lot of exposition on that, but depending on where they're going, I'm not sure whether it merits comment yet.
Okay, but I just find it interesting in terms of what it implies about what was going on during Silicon Valley Bank and the complexity of what they were doing for a fast-growing bank like Silicon Valley Bank. I think no one knew what to do.
And we know that uncertainty tends to trigger people to actually not do anything at all, but just wait and see how things play out.
And that's largely what happened because all the warning signs were in place, as you pointed out, with regards to the bank's own stress testing results. The other thing I want to point out here, and this I think will really resonate with you, John, because this goes to the heart of remediation.
Okay.
That there's a recognition and an encouragement to regulators to evaluate risks with rigor. Again, there's an implication about what was not happening, as well as a way forward to prevent or at least minimize the damage from potential future failures.
I love that point because it ties in very directly to some of the things that I've been jotting down through this conversation. I've been thinking through the so what factor of this. This is obviously an interesting case intellectually and historically, but ultimately we want to be able to take lessons away from this. What should we learn from this to correct our own operations in the future and to make sure that as much as possible we avoid subsequent similar mistakes and banking meltdowns? And the first thing I have at the very top of my list is risk appetite should be evaluated objectively and repeatedly. Now, risk appetite, of course, is not the same as risk, but they are intrinsically associated with each other. And when I say risk appetite should be evaluated objectively as much as possible, what I mean is that you had this population of people, leaders and executives within SVB, who were all very risk positive, who all had their own optimism bias contaminating their assessment of the underlying risk. And it wasn't based as strongly as it should be in the real world numbers, in the real world exposures that they faced and the actual possibilities of what the Fed might do. It was based on what they liked and what they thought was going to happen and what they wanted to happen, but not in objective fact. I also think that we need to talk about being evaluated repeatedly because their risk position probably was valid in 2015, 2016, 2017. It likely shifted quite dramatically during the onset of COVID because the entire business landscape in the world shifted dramatically and really should have been evaluated after the second or third rate hike by the Fed. And from everything that we have available, it was never evaluated. And I think that is directly complementary to the point that the Fed's report card brings up that risk should be evaluated rigorously. And I echo your sentiment that it's really interesting, the implication there that it is not presently evaluated rigorously. It's also a bit concerning to consider that fact.
It's quite concerning. And in fact, I would go further to say that given the backstop that the Federal Reserve is, and let's be clear, there is a certain amount of moral hazard. And while I don't believe it's necessarily malicious in terms of bank management behavior, it does create a Peltzman effect type of phenomenon that naturally occurs, which is, okay, if things go really bad, yeah, I'm out of a job, management's out of a job, but you know that the Fed is not going to let all of these depositors lose their nest eggs. So they're going to do what they have to do. They're going to inject liquidity. They're going to provide security and safety for those folks so that they don't get hurt. So who's getting hurt if we decide to take some more risk? Or if we decide to stay with a strategy that's starting to look a bit more risky and a bit more shaky than it was before when it was working really well?
Well, if you're operating with 90+% uninsured deposits, a lot of people.
Absolutely. But again, this goes back to if there's an understanding, implicitly or otherwise, that there's a backstop, that there's a daddy, then without any material change in the behaviors to create a lower risk appetite, there's going to be more risk taking. We've seen it time and again.
And just because SVB had a high percentage of uninsured assets doesn't mean that's how the rest of the banking world operates. Most of their leadership came in from other banks where this would have been the norm. And people have habits, people have ways of doing business and assumptions that they make. And it's almost certain that assumption of the safety net was present, even if it wasn't specifically merited in the case of SVB.
And I would posit that the safety net was there because eventually they were taken on by another institution. They were merged into another institution. No depositor lost a dollar from this. And I'm not saying they should have. That's a public policy question, and that goes beyond the scope of what we're talking about here.
Sure.
But it goes to the point of management in the back of their minds knew that was a likely scenario. They had seen what happened in the 2008 crisis, where bank depositors were largely protected.
Okay, interesting.
That gets into contrast with what we're going to talk about in our next podcast, which is FTX and these blockchain crypto kinds of systems, which do not have a backstop.
There are so many interesting ways that financial institutions can fail. So then, what are the lessons we can take from this? I mentioned the issue about risk appetite being evaluated objectively and repeatedly, but what are the additional lessons we can take away from this?
From the regulator side, there's two realities that I think need to be addressed. The first and most important one is that if you are not going to allow folks to lose, then you have to have a risk-averse mindset because you have created, whether intended or not, incentives for additional risk-taking downstream with the management of the institutions you're regulating. Which means if you want to make sure that you're able to follow through on things, you have to take a risk-averse approach to how you regulate these institutions.
We could talk about the comment I'm about to make for hours on end. I'm just going to throw it out there as a throwaway, but there are some very interesting implications about that conclusion about any sort of insurance market.
That's correct. It applies to the whole concept of insurance in general. The second thing I want to point out from a regulator standpoint, particularly the Fed, and I'm not trying to pick on the Fed, they've already picked on themselves enough in this whole thing, but it's really important, is to take an enterprise view to how they're running the institution, meaning how they're running the Fed. Because clearly, as these Fed rate hikes were coming into play, you would think There was somebody in-house that was probably nervous somewhere or would have thought ahead to possible downstream effects of all of these rate increases in terms of the asset portfolios of the underlying institutions they're regulating. I haven't seen anything that indicates there was any of those conversations going on.
I love that point because it doesn't even directly lead into, but it's just a rephrasing of the point that I wanted to bring up, that is looking at just operationally that any stress test failure within an organization should automatically trigger an escalation. Now, to your point earlier, yes, there are lots of different ways to interpret results of stress tests, and sometimes it is appropriate to recalibrate your inputs or recalibrate your assumptions when a failure is detected. But that doesn't mean that you should just hand wave away any failures. You should absolutely have those hard conversations, and it should be an automatic event that is triggered anytime a stress test failure occurs. If the CFO and the advisory board had gotten together after this failure and said, hey, let's think through what this implies for us, and maybe let's call our contacts at the Federal Reserve and see what the tea leaves suggest for the next 18 months, maybe not the whole thing could have been avoided, but the complete exposure that they face would have been substantially mitigated.
I concur.
And then the final lesson or takeaway that I have is really one that's more for external observers, whether it be investors, depositors, or even oversight agencies. And it comes off as something that you had talked about in terms of the below the line assets that they held. And that is that when you're trying to evaluate an organization or an institution or a holding in terms of its genuine, real exposure, below the line assets should be evaluated above the line. Yes, that's not the proper accounting way of doing things. That's not the proper regulatory way of doing things. But in terms of figuring out what the true risk of an organization is, all of those things that have not nominally landed as of yet need to be included in those assumptions and calculations. When we just label them as below the line, we subject ourselves to a severe availability contamination and say, oh, they're not important. And I think that's a major failure in understanding how healthy, how safe, and how exposed an organization is.
I would follow up on that point with one time is not necessarily one time. And by the way, one future time might be all that it takes for an organization to fail.
And in the case of SVB, that's exactly what we saw. The fallout of any sort of financial or bank collapse is always very difficult to see until long after the fact. The full impact of the collapse of long-term capital management, the financial crisis of 2008, Lehman Brothers, and what have you, were not clear until 5 to 10 years afterwards. So we're still not completely sure what all the implications of SVB's collapse are. Nevertheless, I think that these are some really powerful and potent lessons we can take from them. And they're part of a greater conversation that I think that we have every intention of continuing in our next episode. There are lots of different ways that markets and financial institutions can collapse. And I'd like you all to join us next time when we talk about everything that has happened to date around FTX and all the interesting ways that financial dysfunction can occur.
So we'd like to thank our audience for listening, and we encourage all of you to reach out to us with your thoughts and encourage you to continue this dialogue with us on this very important aspect of financial management, not only at the institutional level, not only at the personal level, but at the overall systematic level. Thank you for your attention, and we look forward to seeing you next time.
Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Qingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.